Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Fernando Angelucci. Thanks for being on the show, Fernando.
Thanks for having me, Whitney.
Yeah, I'm looking forward to this and just a little bit of our conversation. He's got properties in almost half of the states in the United States. It's pretty incredible and looking to grow. So I'm looking forward to this conversation and the types of properties that he is investing in and why, as opposed to some asset classes that some of the rest of us are focused on. So we're looking forward to this conversation, and obviously he's an expert in this business and very successful. So, but a little about Fernando. As the founder and president of Titan Wealth Group, he leads the firm's finance and acquisitions departments. Titan Wealth Group operates nationwide, sourcing off-market investment properties for Titan Wealth Group's acquisition and as well as serving a network of thousands of active real estate investors nationwide and worldwide. Prior to founding Titan Wealth Group, he worked for Dow Chemical, rolling out a flagship product estimated to gross $1 billion in global revenues. With an engineering background, Fernando is able to approach real estate investing with a keen analytical mindset that allows Titan Wealth Group to identify opportunities and project accurate pictures of future performance. So, Fernando, thank you again for your time and sharing your expertise on the show with us today, or myself and the listeners. So, but tell them a little more about who you are, maybe where you're located, and your focus, and let's jump in.
Yeah. So I'm currently located in Chicago, Illinois. We now primarily invest in self-storage properties, and there's a whole history behind that. I'll kind of keep it short, but when I was an engineer working for Dow, I was really tired of the 9-to-5 life. Well, for me, it's more of a 5 a.m. to 9 p.m. life. And I immediately started investing in single family homes on the side. Within about 13 months, I was able to replace my income and leave the 9-to-5 life to be a full-time real estate investor. From there, I quickly grew into doing flips for single family, buying single family rentals and buying multifamily rentals. And I kept having problems with the eviction process. Chicago is a city where the laws are extremely tenant friendly. And if you do everything by the book, it can take, 6 to 8 months to get a bad tenant out of one of your properties, not to mention, the amount of damage that they cause on the back end. So I was looking for another avenue that would solve those types of problems for me while still providing a very consistent passive income to me and my investors. And that's when I actually I came across self-storage. I was at a real estate expo that I had attended, and all the problems that I had been having, the speaker, it just seemed like he was speaking to me. So we got started. In the beginning, we started off by wholesaling self-storage facilities just to make sure we're running the numbers correctly. The way I look at it is if I can wholesale self-storage facility, that means that I'm getting it at a price that makes sense and investors are willing to pay me more than what I got under contract for. Once we did a few of those, then we started feeling comfortable in taking down our own acquisitions. And then since then, we've been growing extremely fast.
So, Chicago, the tenant issues of evicting, taking 6 months. I could see why that would push a lot of landlords into a different asset class or looking for something else. Because that happened to you. If you just bought a duplex thinking you're just getting started and that happens to you, you're thinking, okay, this is not for me.
Right. And especially, in Chicago, where a lot of people enter the buy and hold multifamily markets, usually in C and D areas, and I was no different. So I started buying properties on the south side of Chicago, which in and of itself brings a lot of hardship when managing that type of tenant. Low income tenant, half of the time they're, on some type of Section 8 program, vouchers. And it is very difficult to manage that. And I know a lot of really good investors that they have that management in place. But for me, I like to go with the path of least resistance, and that was self-storage. So I started to look. I'm a very analytical person. I like data. I like looking at historical performance. So that's one of the things that I actually prepared for the show here, just looking at a little bit of, performance over the last 10, 20 years. When we're looking at self-storage versus other asset classes, there was a study done by NA REIT looking at the 2017 value of $100,000 invested in 1994. So if you put that, $100,000 in the S&P 500, by 2017, that would have grown to roughly $500,000. If you put them in apartments, that $100,000 would have grown to about $1.7 million. If you put them in self-storage, that $100,000 would have grown to a little over $4 million. And when you look at those returns over those periods of time, you see that, the S&P returned about 7.5%, apartment buildings on average returned about 13.3%, and then self-storage returned about 17.4% as an average annual return. That 4% may not seem like a lot, but when you factor compounding interest, that's how you're able to almost double the return in real dollars over that period of time. Now, that's a pretty large period of time, 1994 to 2017. But let's talk about recession tolerance. Between 2007 and 2009, in the same study, we saw that the S&P 500, they lost about 22% in value. The apartment sector did much better. It only lost about 7%. But during that time in the self-storage space, they lost about 3.8% in valuations. And the reason why is self-storage is a asset class that caters to those in transition. And that's true of people who are, let's say, downsizing on their home because they can no longer afford a 2,400 square foot mortgage. Maybe they go down to a 1,200 square foot home, but they have these sentimental possessions that they're not just going to get rid of. If your child, for example, this is an example that I have in my own family. My father, I'm a grown man, but my father still has all the drawings I made for him when I was 3-4 years old, and he's never going to throw those away. And that's the same thing is true when someone's downsizing. Self-storage also caters to the two largest population groups in the nation. You have the baby boomers who are now historically starting to retire, but I think it's about 10,000 baby boomers a day retire. They're looking to downsize in property, and they're also, on the older end of that age are going into retirement homes. And that is a much more confined space, yet they have a lot of sentimental value in the things that they have, and they don't want to get rid of them. So they usually put them in self-storage. It makes a lot more sense to, cut 1,200 square feet off of your housing size and then just go pay for an extra 100 square feet that you need monthly. The second group that self-storage caters to quite a bit is the millennials and the Gen Xers. The trend of moving to the suburbs is no longer, what is driving a lot of development and housing right now. What we're finding in the groups that are, aged 18 to 34 is they're actually moving closer to the city centers because they want to be around the action. They want to be around the, the great food scenes. They want to be around, the event space.
They're not looking for the farm life.
Right. And so what they're doing is they're opting for smaller housing, maybe 700 square feet to 1,000 square feet in these, these high rises, these condos. And then they're using a self-storage space, maybe 100 square feet, 150 square feet is kind of like an exterior closet that anytime, say they want to go hike or they want to go kayaking or they have clothes for the winter when it's the summer, they can go to that unit, pay an extra $80 a month or $100 a month for that, that additional square footage, and it allows them to live closer to the city center at a more reasonable price range. Right. Mm-hmm. So those are the two main things that got me really attracted to this space. Then when I actually started getting involved, I noticed that the leverage that was being offered to me from banks was far superior to any other asset class that I had pursued leverage on before. And I started to dig in to see why that was. So, I'm talking the worst case scenario loans I've gotten so far were 80% loan to value. The last 3 properties I've closed, they actually appraised at a good enough value that I was able to not only close them with no down payment, but I actually was able to pull cash out at closing by purchase. The banks were paying me to buy an asset that had positive cash flow. I don't know of any other investors that have done that in other asset classes. So I wanted to dig deep and see why was that the case. And when you start digging into the data, I looked at Intech Solutions, which is a aggregator. I looked at Wells Fargo Securities, and what we found was self-storage had a much lower default rate compared to any other asset class. So let's just use January of 18 is the most recent data I have. Self-storage, their loans on average across everyone surveyed were defaulting at a rate of about 0.04%. Multifamily in the same stretch was defaulting at a rate of 1.83%. So that's a huge order of magnitude difference. Then when you actually look at the default data, when that rare default did occur in self-storage, the amount of loss experienced by the bank was actually much lower than all other asset classes as well. So you look at multifamily, when a bank disposed of those loans, they usually experience a loss of somewhere around 4.3, 4.4%. Self-storage, the loss per default was at 1.5% range. Again, 3 times lower than that of multifamily. So then I started to see why banks were giving me such great leverage is because they use self-storage to offset the riskier loans they're giving. Specifically, banks that were doing new construction loans and single-family fix and flip loans, they loved our product. It did take a little bit of convincing them by showing them this data and showing them where the data sources came from. But very quickly, if a bank was not familiar with self-storage, very quickly they started fighting for our loans.
Do you know if those numbers are all commercial properties, or is that like from a duplex to any multifamily? Or
so it's commercial multifamily, so 5+ units. Mm-hmm.
Yeah.
Yep. Another thing that I really like about self-storage is the fact that the market is extremely fragmented. Now, what do I mean by that? When you look at the apartment space, a large percentage of the housing stock in the multifamily space is owned by large operators. When you look at self-storage, it's the exact opposite. 19% of all the facilities owned in the US are owned by the 6 largest companies. Another 9% are owned by the next 100 largest operators, leaving 72% of the facilities in the US are owned by what I say, quote, mom and pop operators. These are operators that have 2 or less facilities. That means I have a much easier time finding off-market properties. I can negotiate cap rates that would make, multifamily investors, cry. Right now, my average across my portfolio on the day of acquisition is a 9.8% cap rate. And then when we do the value add, we're usually adding another 4 to 5% onto that internal cap rate. If you tell a multifamily investor you're buying an asset and you can assume that you can pick it up at a 9.8 or a 10% cap rate, they're going to laugh at you, especially in the environment we're in right now where we're seeing heavy cap rate compression, and there's a lot of competition from the big boys with the deep pockets, right?
Wondering how many more, or what the number of properties are though that are self-storage versus multifamily though that are on the market, or just all together.
So as of 2017, the Self-Storage Almanac estimated the total number of facilities in the U.S. to be somewhere between 44 and 52,000. So there is much less when it comes to the number of facilities. But at the same time, on average, 9 out of 10 facilities that come across my desk are off market. There's no brokers involved. And there's nothing wrong with brokers, but they are very good at their job. And their job is to get as many eyes on a facility as possible to raise the price to market, right? When you're the only person negotiating at the table, you have a much better chance of securing that asset at a range, again, that would make some brokers, gawk. Yeah. So the fragmented market is something I really like. The biggest thing for me, which was a huge headache, was, there's no tenants, toilets, or trash. Because of that, you have much lower break-even occupancies. So for example, in my multifamily properties, I would have to keep an occupancy of anywhere between 80 to 85% to pay the bills, right? In my
What type of multifamily properties were you operating then?
So these were 12 to 24 unit properties primarily is where I was kind of my bread and butter. We did some stuff smaller as well, but just for the sake of this conversation. When I did an assessment of our portfolio in the self-storage space, our leveraged assets, we need to be in the mid to high 60% range to break even. For our unleveraged assets, once we purchase cash, we'd need only around a low to a mid 30% occupancy range to keep to be in a break-even territory. And again, it's because of the low overhead. I have minimal utilities, if any. I have some properties where they have no utilities running to them. There's no carpet cleaning, there's no painting, there's no leaky faucets, there's no, winter HVAC failures, there's no water heaters exploding. This is, self-storage is pretty simple. When we're looking at the first generation and some of the second generation facilities, we're talking concrete slab with corrugated metal steel walls and ceiling. There's not much you can do to really mess that up, right? The second thing that I love that's kind of along the same vein is easy quote unquote evictions, right? The reason that I use air quotes here is because they're not evictions. With landlords in multifamily, you have to go through, the landlord tenant law, which is where the evictions lie. In self-storage, we're guided by lien law, or what's called property law. So when you store your possessions at my facility, we are entering into a contract that states, if you don't pay me, I can lien your property, and if you don't pay me in enough time, I can sell your property to satisfy that lien. So a typical, let's talk about some of my last multifamily deals. I had a deal, it took 8 months to get a tenant out of one of our units. We unfortunately inherited that tenant when we purchased that property. And she was, in bed with all of the tenants' rights lawyers, and they kept playing games on us, switching out sensors and smoke detectors so that we kept failing our inspection. So she was able to push out that process into 8-month eviction timeline. Now, not only are we talking about the 8 months of lost rent, but then when she left, she caused $20,000 worth of damage to the unit. She destroyed all the drywall, cut all the electrical, poured concrete down the plumbing. I mean, it was a true nightmare.
I would say part of that is you're investing in the wrong city or the wrong
correct state. Wrong areas, right? So now let's look at self-storage and how that works. On the 5th day, you get a notice that says you have to pay me, and then a manager puts an overlock onto the unit. So now there's 2 locks onto their unit. If they don't pay me within a 30 to 45 day period, from the day of that 5-day notice, I start the lien process. I put 2 notifications into a local newspaper saying, here's the units that we're going to be auctioning off. Here's the date to settle any, issues. If you'd like to participate in the auction, here's the link to the website. We do all online auctions. And within 45 days of that tenant becoming late, we sell all their stuff off. We recoup all of our lost rent. And then someone goes in there with a large push broom, sweeps out the dust, and we get a new tenant same day.
Are there states that have unfriendly, or I guess landlord laws for self-storage operators?
No. So the worst states that we've seen, they just have a little bit of longer timeline. So 60 days as opposed to a 30-day lien process. But for the most part, this is one of those, it's when landlords are being attacked in the news, it's always, somebody, we put out an old lady that couldn't pay her rent. And there's this heartthrob portion of it. And that's why laws become so difficult against landlords in states like Illinois, California, New York. But you're not going to get that same type of heartthrob type situation when you have someone say, hey, this person didn't pay on their unit for 30 days and we auctioned off their suitcases that they had in there. Like, who's really going to feel for that person, right? So that's why I think over time, and this is me just speculating, I think over time, landlord-tenant law has become so strict and restrictive, whereas self-storage law it's been pretty unchanging, if you will. I mean, the process is very easy. The way the laws read, they're extremely in the property owner's favor. So for example, when somebody rents a unit from me, they're already agreeing to the fact that they mandatory have to get renter's insurance for this stuff, and that we have no liability expressed or implied in protecting their stuff above and beyond providing a space for you to store your stuff. If the property burns to the ground, if it gets hit by a hurricane, anything like that, that's not on us, right? That's on you guys or on the tenant. So we have much less liability with this asset class than you would when there's an expressed and implied warranty of habitation, right? There is no warranty of habitation with self-storage because you're not allowed to live in our units, right? So, I mean, it's
better not be, right?
Right, exactly. So there's a lot of, similarities, but at the same time, some heavy contrast. Another thing that I like is, because there's less people involved, there's less moving parts, that equals less management. So for a facility, a perfect example, I'm looking at a portfolio right now of 5 properties. They're all within about a 50-mile radius of each other. All we need is one full-time person to manage that portfolio. Now say if we had a portfolio of 5 apartment buildings that were spread within a 50-mile radius of each other, how many people do you need to run that facility, right? So that's why our operational costs are much lower. On average, we're experiencing, like I said, expense ratios in the 19 to 25% range, whereas when we were doing multifamily, our expense ratios were in the, on the good side, 35%, but usually it'd be closer to the 45-50% expense ratio.
What? Tell me something you don't like about self-storage.
Yeah, so there's a current trend right now. I'm trying to remember her name. I think it's Marie Kondo, about decluttering your life and getting rid of things that are just taking up space in your house that don't bring you joy, and to just get rid of those things. So that's one of the people that are kind of fighting us. But at the same time, if we just put a little bit of spin on it, we can say, hey, get rid of these items in your home, but just move them to a self-storage facility, right?
You don't have to get rid of them.
You don't have to get rid of it, right? Another very interesting development in the self-storage space is technology. Where other asset classes have adopted technology rather quickly, self-storage has been one of those where it's taken quite a while for operators to adopt technology. So just recently are we seeing, manless facilities where there's a kiosk system you use to rent and purchase your unit, to purchase renter's insurance and a lock, and then you can use an app on your phone to open the gate, open your individual unit. It's interesting, the technology that's breaking into the space. But again, it's one of those things where self-storage is a very hands-off type of business that I think a lot of operators have been hesitant to adopt these technologies, which in turn causes these technologies to be pretty expensive when they break into the market. There's an example. There's this one system that one of the largest providers of self-storage doors and dividers provides, which allows all units in your facility to be controlled with a phone app. Right now, it's a little cost prohibitive because it costs about $300 to $350, $400 a unit to install that. But over time, as more investors adopt that technology and there's a scale associated with the vendor, we're going to start seeing those prices drop, right? Another thing I really like in self-storage versus multifamily is that it has a very high sticky factor. So what I mean by sticky factor is, say I have a $150 unit, right? I can increase the rent on that $150 unit by $20 a month, and that would be equivalent of a 13% increase to the bottom line. Now, a renter is not going to take the time and then not only the cost to move to a new facility to save that $20. If we're talking a solid 10 by 15 unit, 150 square feet, that means you're going to have to rent a truck, pay for the gas, pay for the time off to move there and for, maybe get some helpers to move them in and out if they're not able-bodied. You're looking at a $500 to a $600 cost to move to a facility over a $20 increase. It just makes more sense just to stay there for an extra 2 or 3 years and absorb that. Now imagine if you tried to raise your monthly rent on one of your apartment units by 13%. Your tenants would immediately move out. I mean, when we were in the multifamily business and we were raising rents by 3% a year, we would get mass exodus from our units, because one of the things about self-storage versus multifamily is that it's highly localized. For example, I'm here in Chicago. I'm in the near south side of Chicago.
Again, don't buy in Chicago.
Right. But what I can do is if I didn't like where I was living, I'd be willing to move to the north side of Chicago or the northwest side of Chicago. I'm willing to go 5-10 miles away to get a good deal on an apartment. Right. Whereas with self-storage, usually what we find is 90% of our tenant base comes from a 3-mile radius around our property. No one's going to drive 50 miles to go save an extra $5-10 on a unit. So they're much more, our tenants are much more sticky, if you will. And then the last thing that I really like about self-storage is the fact that you have multiple profit centers, not just rent, right? I have a list here of just some of the most common profit centers, ancillary profit centers that we add to self-storage. We can do car storage, boat storage, RV storage. We can sell locks. We can sell renter's insurance and take a premium. Maybe 60% of our renter's insurance premiums come right back to us as the operator who's selling and pushing that product. We can sell moving supplies, packaging supplies. We can do FedEx. We can have printing services. We can add cell towers on our land, billboards that we can rent out, truck rentals, private mailboxes, wine storage. It's just the list goes on. And that way I'm not beholden to one way of making income. Everyone that likes to talk about passive investments and talk about building a portfolio, they say, it's all about multiple streams of income. Now, what if I told you that you can make 5 or 10 different streams of income off of just one real estate asset? That's much better than buying multifamily and the medical office and, industrial property and single family homes and Airbnbs. It's just one of those things where the more and more I looked at it, I couldn't not get into the space. And
How do you feel about like the growing competition right now, or as far as lots of people trying to get into self-storage business right now? Or do you feel that that's, it's extremely competitive, or how do you feel?
Yeah, I mean, I love it. So I break apart competition into 2 brackets. There's the REITs or the pseudo REITs. So these are the guys with the deep pockets and they're driving up rents in areas. I like when they come into an area near me. I specialize in Class B and Class C properties in secondary and tertiary markets. So when a large REIT competitor moves into town, they immediately raise all the rents for the entire market. And all I have to do is I just piggyback off of their marketing. So I don't even have to pay for advertising. And I just undercut their price by about $5 per unit. And now I'm getting free leads coming my way just because someone's price sensitive and they're shopping. Now on the lower rung, you have the newer investors coming into the space. I don't really look at any one of these people as competitors. I always look at everyone as a potential partner. These are investors that they want to learn how to get into the business. Maybe they're buying their very first facility. Maybe they need help buying their very first facility, and they end up calling me in the markets that I'm have a heavy presence in, and either bringing me deals, bringing me capital, just to show them how to do the deals. Again, like I said before, self-storage is a hyper fragmented market. So to get to the point of competition that you're seeing in multifamily, it's going to take the big REITs. They have to buy another 60, 70% of the market, which is not going to happen. It's just impossible to get to that many owners in such a short period of time. So for the
all right, Fernando, just a couple more questions before we run out of time. How are you all prepared for this potential downturn that everybody talks about?
Yeah, so the reason I went into self-storage was motivated partly because of that. Like I said, in downturns, self-storage performed better than any other real estate asset class.
And what's a way you all have recently improved your business that we could apply to ours?
Yeah, I think it's very important to get a common vision across your entire organization. So we actually hired a EOS implementer from the book's Traction by Gino Wickman. And as soon as we brought that in, our company started growing by 200%. It was just important to get the entrepreneurs in the company organized. When entrepreneurs, they usually are very gregarious, and sometimes if you have a bunch of them in the same room, they start butting heads. So it's great to bring in a third party that has no horse in the race to say, hey guys, here's what I'm hearing your common goal is. How do we apply that so that we're all moving in the same direction?
Yeah. And what's your best advice for caring for an investor so they want to come back to the next opportunity?
Yeah. So with our deals, what we do is we never will cash an investor out. So once they put their money into our deal, there'll be a capital event to return their capital, but then they stay an equity owner in that deal for the lifetime. So our model is not to ever, if we can help it, not to ever sell any properties, and just to keep adding for passive income. And we think our investors should come along on that ride with us.
Nice. And what's the number one thing that's contributed to your success?
I'm going to have to say standing on the shoulders of giants. Nothing here that I've said today, I came up with myself. It's all been my mentors and my coaches that I've surrounded myself with. If you surround yourself with people that are performing at a higher level than you are, you're eventually going to rise to meet them at that level.
And how do you like to give back?
So we love to do volunteer events. It's actually part of our mission in the self-storage company. We give back to the local communities that are, patroning our facilities. So we do local events supporting, baseball teams, soccer teams, the police force in the area, do a lot of food drives. I come from Brazil, where, food stability is not guaranteed. And then what we've noticed is, even here on our own soil and in our own backyard, there's people that they don't know where the next meal is going to come from. So no sense in sending money to a different country when you have people right in your own backyard, other Americans that, are insecure about where their food's going to come from.
Well, Fernando, thanks for giving back in that way. And I appreciate you giving back to the listeners and myself. I wonder how many you've convinced, from multifamily or from mobile home parks or some other asset class to, to self-storage.
Right.
But tell them how they can get in touch with you.
Yeah. So easiest way is to just Google my name, Fernando Angelucci. You can find our websites, our Facebooks, our social media handles. I also give out my cell phone number to people. I'll do it right now. It's area code 630-408-8090. That is my number. Shoot me a text message. Give me a call. I'll answer any questions you have. I'd be more than happy to help.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.